As promised, how does lease classification impact the financials? For an operating lease, there's going to be a single lease cost on the income statement. That's calculated taking the remaining costs of the lease divided by the lease term. That's how you get that straight line rent expense. When you're going to record your monthly journal entries, you would debit that lease cost that you've calculated. You would credit your lease liability. This would factor in the interest expense, even though you are not charging interest expense to the income statement. This is how it's getting factored in. Then your plug here would be a credit to the right of use asset. When you're recording your monthly cash payment, you'll debit your lease liability, credit cash. Now on the finance side, there's going to be two items on the income statement. There's going to be interest expense and a right of use asset amortization. The right of use asset amortization is calculated taking the beginning right of use asset balance divided by the shorter of the remaining lease term or the remaining useful life of that asset. That's going to generate a more straight line expense as well. But how it gets to be a front-loaded expense recognition pattern is a direct result of the interest expense. Obviously, as the lease liability balance goes down over time, as does the interest expense. When you're recording your monthly journal entries for a finance lease, similar to any other PP&E, you'll debit your amortization expense, credit your accumulated amortization, then to record your monthly cash payment, debit your interest expense that you've calculated using the effective interest method, similar to any other type of debt. You'll credit your cash that went out the door, and your plug here will be your debit to your lease liability.